Well, good afternoon and good morning, everyone. And thank you all for joining us at this most recent edition of our dialogue series at the Bretton Woods Committee. On behalf of the Advisory Council and the Bretton Woods Committee Board, I just want to welcome our global membership audience for what I know will be an enlightening, candid, and very timely conversation on so many of the big issues du jour that impact us today. And allow me to take a moment to double click on the word timely. You know, since our last dialogue series and conversation, the global convenings in Davos, the convenings that we saw just recently over the last several days in Munich, which has been much more high profile than normal, literally fall into the category of unprecedented. I know that sounds like hyperbole, but we're truly living in an unprecedented moment. When you take those geopolitical themes, what kind of themes, you ask? Well, I don't know, German Chancellor Merz talking about a world order that stood for decades no longer existing, that we're seeing the end of great power politics, that freedom is no longer a given. Macron echoing similar things, and Marco Rubio talking about new geopolitics area because the old world is gone. That sounds pretty stark and unprecedented to me. And it comes off of what was truly a historic and fairly interesting Davos experience where I know many of our members attended firsthand and would corroborate that. And when you combine that with the themes that we've seen here that we've been exploring at the Bretton Woods Committee in terms of the future of finance, and you combine geopolitical instability with geoeconomic instability, it makes for a very, very interesting moment. And my last point before I get to our key featured speaker today is I would make the observation that there's never been a more important moment to be dialed into these conversations, where it's never been more important for the Bretton Woods Committee to have a say when we think about leading conversations and advancing economic cooperation and communication. This is our moment as a membership organization. And I especially want to thank Bill and Carolyn Wilkins for championing the future of finance subject matter that we're bringing to you today. Well, let me dive right in, if I can, and introduce our next speaker, a gentleman who I've gotten to know on multiple dimensions. Austin Campbell is a world-renowned thought leader in the topics of digital assets and the future of capital markets. He's somebody that I got to know quite personally while attending an event in Arlington, Virginia, many, many years ago, volunteering his time to educate veterans looking for careers in the digital asset industry. It was there that I first was introduced to him, and I became fascinated and intrigued by his intellect and his ability to communicate very complicated, easy for me to say today, very complicated material to wide audiences. He also has a very unique perspective as a gentleman who worked at some of the largest financial institutions in traditional finance. He's also found his way towards advising those very institutions on the future of finance, be it crypto, be it stablecoin, etc. And I think that unique perspective that he's bringing to bear, I think will be appreciated by this audience. I'm also very, very happy to call him a friend and a colleague as a fellow professor at New York University. But without further ado, Austin, I wanted to welcome you to our dialogue series. Thank you for carving out the time to share your insights with our members, and great to see you again as always.
Yeah, it's really nice to be here. And I think to double click on what you said to start, the timely comment is nail on the head in terms of where we are in the world right now. I would say to everybody, if sort of future markets transformation and digital assets has been a thing that's either been in sort of the side of your view or maybe even completely out of view, getting up to speed right now probably puts you in the vanguard of traditional financial people coming into this space. So your timing genuinely couldn't be better. You're neither late nor early.
Mhm. Well, it's nice of you to say that, and I really do mean what I said. I think under Bill Dudley's leadership and Carolyn Wilkins' leadership on the Future of Finance Working Group, we've really helped, I think, to advance the level of education and the kind of pragmatic examination of these topics. But let's go back into the Wayback Machine a little bit. We want to look back and, you know, Austin, you've had experience with some of the most famous banks in the world, and really had an education that you were plucked from a meteoric career in legal affairs, if I'm not mistaken, at NYU with a dual major at the time. but I think you were lured by JP Morgan into a more traditional financial service capital markets role. How did you go from there? How did you first get involved in the crypto industry, the digital assets industry? And you can take us all the way through to your leadership work, really pioneering leadership work at Paxos in the stablecoin space. And I'll leave it to you to go from there.
Yeah, I mean, as my wife would tell everybody if she were here, I'm fundamentally kind of a grouchy person. And I think that informs the journey that I've been on here, which is to say, as you said, I was at JP Morgan and I had taken on a trading role after the financial crisis. I was first part of the distressed debt group and then later on part of what was, a component of global rates at JP Morgan, running, for lack of a better way to put it, a lot of the weird stuff that had broken during the financial crisis. So I had collected this motley assortment of businesses that included, in particular, something called stable value wraps. So for non-Americans, stable value exists in the retirement space in America, right? It is a product, there's about $1 trillion of it out there in the world. So this is a major thing. And if I were to tell you the following characteristics, which is to say it's a product where participants need to be able to transact at a fixed stable value at all times to get in and out of this fund. And yet underneath is a large pool of securities that may be actively traded or managed over time. This is both essentially how stablecoins are created, but also long before stablecoins were on blockchains, how stable value funds work. And I spent a long time in that space and putting that back together and got sucked into the regulatory reform efforts around money market funds and like cash stability products in the United States, right? Doing some work with the Boston Fed, the CFTC, things like that while I was at JP Morgan. And one of the big lessons from that I learned was one, craftsmanship matters in these spaces. Like
Yeah.
often we talk about things theoretically, but what do you actually do with your hands that drives success? And then the two, very few people actually understand the mechanical details of how these things work, and they're very important. And it was that, if I'm being honest, constant complaining to the operational risk committee at JP Morgan that got me pulled into blockchain world because I was asked to look at, hey, we've got this thing that you've been complaining about instant settlement and counterparty risk for like
What's the
ever.
time? Forgive me. What's the timeline context here for our audience right now?
20,
Yeah.
travel back about 10 years to like
Yeah.
2016, 2017,
Wow.
right? When people are first thinking about private blockchains and smart contracts. And let's be honest, the original like driver here was just instant settlement, right? So leave blockchain out of this. Let's talk about things that actually matter in terms of problems in the financial system, which is to say, if you're in rates trading and it's 2008 Friday afternoon at JP Morgan, and you get a phone call and a client says to you, I want to sell you $100 million of treasuries, and you decide whether you're going to bid that or not. If you can't settle that instantly, if you've got to take forward settlement risk over the weekend, you're going to give a very different quote at that time to, say, Wells Fargo versus Lehman Brothers. You might
Yeah.
not even give the latter a quote. On the other hand, if I can settle that instantly, and if it's not done, the trade breaks, I'm giving roughly the same quote to both sides. And so things like that were sort of infrastructural issues that I cared about in finance. So I ended up having to look at what was JP Morgan's early efforts in the blockchain space. And then I ended up at a place called Stoneridge, which is the parent of NYDIG. And again, it's sort of the curse of knowledge of I had done a lot of work with structured repo. And so the people attempting to lend money against Bitcoin came to me and asked me for help. So I had to help them with that. I ended up out the back of Stoneridge at Citi, where I was the co-head of digital assets and global rates, kind of helped them come up at the time with their strategy around all of these things. Though, being honest, that was a very hard time for Citi in particular, thanks to their fumbles with the Revlon issue. So I have some sympathy for their moving slowly there. And then out the back of that, I ended up at Paxos because while at Citi, I'd been talking to them about reserve composition and how are you managing things. And like, with all due respect, guys, what the heck are you doing here? And rather than hire Citi to fix it, they just hired me to come fix it. So I spent all of 2022 essentially rebuilding the internal workings of the stablecoins at Paxos. So that's how do we manage the reserves? How do we track them? What is transparency like? So you may have noticed in 2022 is when stablecoin issuers started reporting the entire reserve down to the QSIP level in
Yeah.
the United States. That was us at Paxos leading that. And then a lot of this was also risk in general. Like I ended up, this is a very startup thing, catching the chief risk officer title because just like, yo, what are we doing to monitor all these things? How do you have good controls, good housekeeping? And it really led me to this place where I've kind of lived in the largest banks and like the largest bureaucracies possible in finance, where they've been very good at managing risk for very long periods of time, right? Like maybe nobody has been better at this historically than JP Morgan. And on the other hand, in startup world, where you're trying to disrupt all of these things and rebuild things, but they're going to have to learn all of the risk management lessons, and hopefully not by just stepping on every single landmine themselves, but rather learning from the experience of others in history. And it's sort of that collision that's brought me here. And, I'll jokingly say to the group is maybe kind of a controversial figure on both sides because I see both the advantages and the follies in both spaces.
Well, we'll have a good time kind of examining the hypocrisy on both sides as it comes to this next subject. Maybe there's a world in the future where the United States, in terms of financial services and banking, all roads no longer lead to New York or Washington. But right now, that's not the case. And if we're going to talk to somebody like you, we have to talk about stablecoins, one of the hottest issues du jour, as I mentioned before. And nothing could be more intriguing and interesting than the current battle that's taking place in Washington. For lots of folks that are veteran DC insiders, they comment offline about just how much money has been spent between the Genius Act, which we'll spend less time talking about, and the Clarity Act. In the aftermath of the Clarity Act, more money has been spent kind of parsing out some of these important pieces of market structure legislation. And for our global audience, just to remind everybody, there's only been one piece of legislation or law actually passed here in the United States in Trump 2.0. And that was, in fact, the Genius Act, which codified what you were already operating under at Paxos, right, Austin? I mean, New York
Yeah.
DFS had already set regulations for stablecoins long before. In fact, I'm not sure if you were doing the testimony that day when Maxine Waters kind of asked Adrian Harris, is there nowhere where we have regulation? Adrian Harris said, we've been regulating it and so forth. But I wondered, can you kind of map out where we stand with the Clarity Act for everybody, why it's so important from a broader, kind of second, third order perspective, and maybe talk about the hypocrisy that's going on. Now, I don't want you to go down the rabbit hole with Glass-Steagall and all of that, because I know you can, and I know you have, and I know we did just recently. But it is important, right? Because it does frame the hypocrisy, at least on the banking side, a little bit better. But I'll leave it to you, please.
Yeah, and I think some of it is also an educational problem, if we're being honest. So let me unpack some of what you said. I'll start by saying, yes, I was sitting next to Adrian when that happened,
You
and we
were
both
on
kind of looked at it. We both kind of looked at each other like, which one of us is answering this? So that was a fun moment. But it speaks to the education problem. So one, clarity for those who have not been following the US side of things. That is the act governing what I'm going to call larger crypto market structure. Stable coins are sort of a compartmentalized, understandable thing. And exactly as you said, Greg, they in Congress have been working on this for a while, took a lot of the work the NYDFS had done from 2018 onwards. And I will remind everybody, no NYDFS stablecoin has ever failed or had a peg stability problem.
Yeah.
And why is that? They stole the homework of the Boston Federal Reserve on money market reform. So there's like a straight line from crisis reforms to genius. And to be honest, it largely works. Okay, good. Clarity is everything else. Where does the SEC have jurisdiction? Where does the CFTC have jurisdiction? What do we mean by trading things online and on chain? Because one of the things you run into is if you go and read something like the 1940 Securities Act, you're living in a world of paper tickets and centralized intermediaries. And the idea of like having some sort of automated electronic ledger doesn't exist. Like I will remind everybody, the internet did not exist,
It
right?
wasn't
Like
that
much less
long.
blockchains.
Yep.
Yeah, exactly. And like if you want to understand how long ago it was, I believe technically the 40 Act is closer to the American Civil War than the current day in terms of its creation. So this is a while ago. They did not contemplate these things. And so concepts that exist in there that are very well intentioned, like central clearing,
Yeah.
kind of don't really apply effectively. So a lot of what Clarity is doing is trying to set the boundaries of these rules. And I would say there are several balance points in Clarity that are sort of up for grabs. One is, again, the dividing line between SEC and CFTC. Another thing is how and should we map these requirements from previous securities acts onto blockchains? Where do they apply? What exemptions are we going to give? How much can we delegate? And those are very complicated mechanical questions. I have doubts that we'll get the right answer in the first version here, but that's just the nature of doing the thing. Like perfection is probably not possible. I would
Sure.
say the two hardest ones, and maybe where we could dive into your comments are, one is the AML KYC discussion. And I'll remind everybody, this is one of those things are fundamentally different, right? Like you'll hear the refrain sometimes from regulators of same activity, same rules. Let me be the first to tell you this is not the same activity. And what I mean by that is in the current financial world, if you want to transact or trade anything, like in the United States, it's like getting into a private building. You show up with your ID, you have to check in, they have to screen you in, and then once they've done all that, you can go in, but nobody outside can see what's going on, right? Like there's
Yeah.
walls and doors and it's non-transparent. On the other hand, a public blockchain kind of operates more like a public park, which is to say, the presumption is anybody can get in. You can get kicked out for bad behavior in many of these cases. And equally importantly, everybody can see what's going on, right? Like public blockchains are public and people underestimate that. So the rules frameworks that you use are more like the internet than they are like traditional banking. And I think this has thrown people for a loop in Clarity. Two is the yield debate around stablecoins. And I'll say, in addition to some hypocrisy, I think there's some of that. Um, there's also a really large education problem there. When you look at the lobbying coming out of like the American Bankers Association, the Bank Policy Institute, the community bankers, their main worry is deposit flight. And the headline item there is this study that claims there will be $6 trillion of deposit
Yeah.
destruction, produced, of course, by the banks themselves. And I look at this as a former fixed income trader, and I'm just like, citation needed, guys. And the reason I say that is that I'm going to say something that what I'm about to assert is a fact. Like, this is not a matter of opinion. The creation of a stable coin has no impact on the amount of bank deposits in the system, right? If you create a stable coin, I did many, many, many billions of dollars of this at Paxos, right? You take a bank deposit from the person who's the buyer and you give it to the seller. That is a net transfer. It's just like buying a sandwich. The act of buying a sandwich does not destroy money. It just moves from party A to party B. And then party B here, the issuer, takes that money and either keeps it as bank deposits, deploys it in the reverse repurchase market, which, by the way, is what the majority of issuers are doing right
Yeah.
now. So it
Yep.
stays as a bank deposit, or they buy T-bills. And they're buying T-bills in the secondary market. Now, the only way that can destroy bank deposits is if the bank themselves decides to sell the T-bills off their own balance sheet to the issuer. That is a balance sheet reduction, but nobody is forcing a bank to do that. That's a bank choosing to do that. This is a closed system. There's no deposit destruction. So when I hear the bank policy people saying, oh, stable coins will destroy $6 trillion of deposits, and like you're in meetings with them and you ask the question, well, does creating a stable coin destroy a bank deposit? They confidently answer yes. You found a lot of the problem here, which is an educational one, right? It's like
Yeah.
you don't
Yeah.
understand the chain of transactions and the ledger activity here. Now let's go one layer further.
Yeah, I have to say, let me just
Yes.
interject really quickly. I mean, we've come a long way. If you're going to give credit, regardless of partisanship, to the halo effect of Trump 2.0, general conversational awareness on these issues has gotten much better on the Hill and those that are servicing it. And I used to roam around back when we first met, frankly, asking and speaking to people on the Hill, what their thoughts were about the proliferation of CBDCs in the United States. And the answer I most frequently got was, I'm in favor of it for medicinal purposes, but not for recreational use, which obviously means they had no idea what I was talking about. And I think we've come a long way. But now what you're saying is the devil's in the detail, and there's such an additional level of nuance that is still lacking in this debate and this conversation, correct?
Yeah, and I mean it's sort of endemic to the problem of large banks and how the system operates, which is to say 90% plus of the people at a bank don't understand how bank deposits operate and transactions, right? It's because they
Yeah.
don't have to, right? There's a real information and sort of fragmentation problem going on here. It's become the, as opposed to the too big to fail problem, the too big to manage problem, right? It's very hard to have one person who understands how the machinery works.
Yep.
Okay. The other thing this leads you to is stablecoins, then, if you properly understand what's going on, which is to say they're a wrapper around these other types of assets. Like in your head, if you're listening to this webinar and you've thought of stablecoins as themselves a security or like a core financial asset, I would instead encourage you to think of them much more like a mutual fund or an ETF, which is to say they are a container that you put other assets into, right? The stablecoin is just a wrapper for things on a blockchain. And that tells you the important part of that is actually the blockchain part, right? And what you end up with there is a much more open access system, a much more composable system, and one that, in some ways, I'm going to bring up a bugbear that the crypto people talk about all the time, which is decentralization. But what I'll say here is probably a good tool for rebalancing who gets to determine the rules of the system. And what I mean by that is this: if you go talk to some forms of like the cypherpunk crypto maxis, they'll tell you decentralization is like millions of anonymous people validating a chain where nobody can control something. And I would actually say, interestingly, while on some metrics that's very decentralized, it's actually incredibly centralized in a lot of other ways because there's like real correlation between the types of people who will do that and the decision
Yeah.
making involved. So let me propose a different framework that maybe would be of more interest to the Bretton Woods Committee. Imagine a blockchain where there are only 500 validators. We know who those validators are, but those validators are the 500 largest financial companies in the world. And by financial companies, I now mean a mix of banks, asset managers, payments companies, insurance companies. And by globally, I actually mean globally: the United States, Japan, Germany, the UK, China, so on and so forth. That would be a system where if it were being operated by all these people and it required supermajority consent to change the rules, would be very hard for any individual sovereign party to like put their finger on the scale and overwhelmingly drive it one way or another. And where this leads you to is, oh, wait a minute, maybe there is some sort of consortium or balancing effect that we can achieve with these systems that will make people more confident about using them because they have all of these features and then are also transparent. So I, as guy who spent like 6 months trying to find a bond that had been repoed through Lehman when we were unwinding that whole thing, now take 5 minutes with a block explorer and I know exactly where it is, instead
Right.
of ending up calling this poor guy at UBS like six different
It's
times.
it's such an important notion, Austin, because I think the byproduct of the kind of global change in tenor of the conversation is these long-standing Bretton Woods institutions are coming under incredible duress, and I think the only way to get out of that is the science. To borrow from the movie, The Martian, right? We have to science the what out of this, and it's right in front of us when you think about it. That actually this could answer and provide the level of gravitas and selective transparency to be able to cast aside some of those concerns about bureaucratic bloat and where does all the money go and all of those things that are there. I want to go back into this kind of debate now around Clarity Act. Depending on who you talk to, yesterday there was a convening in Mar-a-Lago where many of the largest players in the digital asset industry went to the president's residence in Mar-a-Lago. Among those was Brian Armstrong, the CEO of Coinbase, who changed his tune over the last couple of weeks and said, I do see a win-win-win solution, which is a very, very different hymn than we heard a little bit ago, which is no is better than bad, meaning no legislation is better than bad legislation. So it seems like there's some momentum. And indeed, while we're doing this right now at this moment, there's a convening in Washington, D.C., I understand, taking place with the powers that be that are a part of this debate. But Can you speak a little bit more to the specific hypocrisy that some of the you might say, dost thou protest too much with the banking industry around this notion of rewards? Because it seems to echo. It seems like there's a role reversal here, going back to the Clinton administration when they seem to be on the other side of the competitive fence. Can you break that down a little bit more for our members, please?
Yeah, and this is some advice I've given to some of the bank policy people is please be careful of what you lobby for here because you may not like how this boomerangs back around onto you, which is to say, banks spent about a decade and a half lobbying from call it the 80s until the end of the 90s for significantly less restrictive regulations on banking
Yeah.
activities. I will remind everybody in the 1933 Act that created the FDIC, there were two other important things in there. One is Reg Q, which is a ban on paying interest for banking products that was repealed due to the lobbying of banks because, and this was their argument, it makes them uncompetitive against other options and people will therefore not use them. Ironic to see them forcing that upon a competitor. Two, Glass-Steagall, which is to say the price of the FDIC was you guys have to split up commercial banking from securities trading and
Yep.
investment banking. Okay. So I've been telling the bank people, if you want to go back and argue that your balance sheets are so weak that you cannot handle competition and that this competition should be restrained, you should be very careful about the kinds of questions that will follow on to that. Because if you start going back down the pro-regulation path, the framework is already there and you're not going to like it. Right. Essentially, you are arguing, even if you don't realize it, that Gramm-Leach-Bliley was a mistake. And we should undo that and go back
Yeah.
to the 1933 and onwards era of banking regulation, which, unpleasant truth for the bankers in the room, that is the period of the least bank failures and greatest banking stability in the United States of America. So, from a factual basis, there are some good arguments there. And by the way, you guys are not politically popular. So, I think we're kind of going to reach this path on the hypocrisy point of listen, either we largely need open and fair competition between all of these groups, or if we start going down the re-regulation path, you don't get to choose where that train stops. Like it may just keep going much further than you expected it to and bring us vastly further back. If you don't believe me, go look at the history of financial regulation on that. But when you 180 your own arguments that you have previously made to then argue your opponent's position from the past and say that was right,
Yeah.
you might not be able to close that Pandora's box, and it is quite hypocritical.
Yeah. Can you speak a little bit? One of the other there's it's not even whispers. I mean, certainly it was always an issue. The concern from mostly blue kind of members on the Hill that the conflict of interest that we've been seeing with the president and the family and other members of the inner circle around some of these issues has made it hard for many Democrats to support this Clarity Act wholeheartedly, with perfect timing. You saw both the pardoning of CZ, the founder and CEO of Binance, which was given some of the most significant, if in fact at the time, the most significant fines by our regulatory bodies here in the United States. In fact, the gentleman served time for the violations on behalf of his company. He was pardoned, and that started to really, didn't make the news cycle, but on the Hill, it made the how do we possibly reconcile that, especially with all of the intertwinings of Binance contributions to some of the family related. And again, to be clear, let's be honest. Senior politicians have always had business entanglements before they became into politics. That's not new. But what appears to be the depth of this, I think, is concerning many people. Do you view that as one of the issues that may change the structure of the structure bill a little bit? How do you weigh in on that?
Yeah, if anything is likely to kill it, I think it's that exact topic that you just brought up, right? Because I think it's impossible to look at what's happening with the Trump family in particular, and regardless of your personal view on digital
Yeah,
assets, right? And again,
yeah,
I'm very pro the future of this technology, maybe despite most of the things that have been done with it so far. and say, I think it is a good thing for the president to deliberately promulgate and pass legislation primarily for personal benefits in this space, especially when it looks like he's taking money into projects that otherwise wouldn't have been noteworthy without his name on them to do political favors for people, right?
Yeah.
This very much looks like from the outside a pay to play structure. And again, I'm not a mind reader. Like I'm not inside the president's mind to answer that. But when the appearance is that bad, you can see why it gets people upset. Now, as you've said, this has been a long running issue. You can also look at like all of the fury around like Nancy Pelosi's stock trading if we
Of
want to look at the
course.
Democratic side of
A hundred
things.
percent. A hundred
And
percent.
so I think if you're going to have Democratic votes in the Senate for the Clarity Act, there probably needs to be some sort of ethics amendment along with it about government actors participating in these spaces. And I think once you open that box, if you're going to proceed down that road, it can't be specific to just crypto, right?
Right.
You probably need to look at all business entanglements because, like, as you know, I did 60 minutes on this exact topic. And, when I was discussing with them, one of the things I asked was like, well, would we have been any happier if he did this through the hotel chain? Right? Like, no. And so the answer you ultimately get to is this is not a crypto issue, it's an ethics issue. But because crypto was the vector, it's going to be impossible to get around it without addressing the ethics issue.
Well, we'll see what happens, but it looks like one of the most significant contributors to the digital asset PAX and to the campaign cycle last go around was, in fact, Brian personally, Brian Armstrong, as well as Coinbase. And that was a significant softening of tone. So we'll see what happens. And the reason we're spending so much time on this topic, because it is consequential legislation. So, what aren't people, when you think about Clarity Act, we've talked about what everybody else is talking about, but with your takes on it. And good old Reg Q, I love that. You know, nothing like Reg Q to get everybody excited. But what are we not talking from your perspective? All right. What are we not talking about that surprises you that we should be talking more about that's been lost in the shuffle of these kind of themes that we've already teased out?
Yeah, it's very much become crypto versus TradFi in this debate when the reality, if you look at what's internal to this bill, is
Yeah.
traditional financial services are actually the biggest beneficiary here because this opens up things that were not previously possible. And again, right, like I am fully aware of the existence of meme coins, of like the pig butchering scammers, of many of the bad trading activities in crypto. But those are actions taken by people. That is not a statement on the value of technology, right? Like somebody causing a car crash is not a refutation of the value of transit. And so when you look at this from a traditional financial perspective, tracing and understanding where assets reside, how you manage your counterparty credit risk, how we can get to better systems of settlement, how we can break apart some of these too big to fail entities that really have become existential and sort of force the hand of governments with bailouts and distort private markets. This is a solution to many of those problems. It helps a lot with like international correspondent banking. That you can go down this list of like very positive things in technology. And by the way, as a result of that, if you could draw the parallels correctly, things that should be in clarity that we're not talking enough about. Like here's a very basic one that also I will point out somebody had right, and it was very beneficial, which is in traditional financial services, we fully understand it is a big mistake to let the exchange also be the custodian because the possibility for nonsense becomes
I thought you
exponential.
I thought you might go there. Yeah.
Yeah, as you let everybody do everything. And so, like, of course, crypto claiming to be this decentralized space has created the densest, most centralized financial entities ever, which are crypto exchanges. And, probably the most notable of those in the bad way is FTX. FTX would not have been possible if that was happening. And I can say that with 100% confidence because there's one jurisdiction in the world that forced FTX to split up the exchange and custody, and that was Japan. So
Mm-hmm.
anybody thinking about this issue, please go talk to the FSA in Japan. They
Yeah.
had the blueprint for that. And I will remind everybody that FTX Japan customers did not lose their money,
That's
right? The
correct.
assets were held in segregated custody. So again, remember how way back at the start I said craftsmanship is largely the issue here? right? Many of these are lessons we know and just need to get the discourse to a better place so that we can apply them correctly. And then we're
Yeah.
going to be able to build a much better system. But that, like in the clarity debate, that's one good example. Another good example is as you think about like SEC and CFTC regulation. Again, I'm a former derivatives trader here. Do not set up regimes that give people differential treatment purely based on which ledger they put things on. There will be a small army of traders like myself who will go look at all those rules and immediately arb them as much as possible to our maximum benefit. Like your nightmare scenario globally is you pass some form of crypto legislation or some form of rules and regs, and the number one winner turns out to be like Goldman Sachs's exotic credit group. Right.
You know,
You don't want that.
water and traders follow the path of least resistance. It's
Right.
interesting you brought up Japan. I can remember some of the earliest conversations as a member of the Bretton Woods Committee and when it was dark days, the most recent dark days. And indeed, I think I was arguing to people all the time, let's not recreate the wheel. I think the Japanese regulatory community really got that right and nobody was talking about it. But while I'm on that, and I've interrupted the flow, stay on this for a second. But are there other regulatory regimes in other parts of the world that you look at and say, they've gotten things right or they're building something correct? Conversely, are you concerned about any more high-profile regulatory, regimes that you think that get a lot of attention but are not getting it right?
All right. So in terms of ones that have gotten it correct, a jurisdiction that people should probably pay more attention to on this front is Bermuda.
Yeah,
They, for those who don't know, are one of actually,
three-tiered safe harbor, right? That's
yep,
amazing. Yeah,
and one of the larger financial regulators in the world because of their dealings with the reinsurance industry, which again, back to globally systemic type things, there are some very large reinsurance companies that have to like set up captives with segregated capital inside of specific
yeah,
structures that, I'm not going to say reinsurance has been perfect, but we had very bad experiences in that space from like a core like peril standpoint, like California wildfires, major hurricane years, typhoons, and a lot of those structures worked as intended. There are some lessons in there. And again, Bermuda had a stablecoin regulatory framework, has some
yeah.
tokenization frameworks. It's worth paying attention to. Japan is another good one, as you said. I would tell you, Japan is like a very mixed bag of they got some of the core conceptual stuff completely correct, but they also made a mistake, and we'll get to more of this mistake later, which is over specifying specific technologies, right? Like, for instance, custody there had to be 95% cold storage using specific methods onshore.
Yeah.
And it
Yep.
turns out, actually, multi party computing might be better than some of the things they specified. So don't do the equivalent of saying how the internet works in 1995 is perfect. We're never changing it, right? You need to be open to some degree of change. But I think Japan has realized that is moving forward to their credit. Um, Things that don't work. I am sorry to do this to you, my friends in the EU, but Mika is pretty malformed. And I say that because it kind of attempted to apply a top-down framework without looking at the economic reality on the ground or consumer demand, and then just assumed the market would fit into that framework when instead what the market did is looked at that framework, said it's unusable, and then went the other way. So like, I'm going to tell you this. One of the core drivers of Tether's profitability is Mika. And what I mean by that is the stablecoin provisions in there, which require a large proportion of the reserves to be held in credit risky deposits, which are
Yeah.
not interest bearing at mainland European banks, are so bad that it crippled euro stablecoins. Nobody uses them. And
And
Europe is
it drove fund. Yeah.
right, exactly. Drove everything offshore. And, ironically, the Trump administration should be sending whoever wrote that section of Mika flowers, right? But it is the classic unintended consequence of when you make something that's malformed and like not comporting with the underlying understanding or market norms for the product,
Yeah.
you may just cause somebody else to win. It's kind of the same problem, by the way, with yield and stablecoins. Like
Yeah.
if the US bans yielding stablecoins, that's not a ban on yielding stablecoins. That's a ban on yielding stablecoins in the US. We already had the euro dollar market evolve because we refused to acknowledge those things once. It's just kind of going to be repeating that sin.
Yeah. Yeah. It's unfortunate because once again they had what I'm not going to say first mover advantage, but as one of the largest trading blocks, and obviously a lot to gain by getting it right. It's been unfortunate. I noticed you didn't mention any of the kind of novel regulatory bodies coming out of the Middle East, whether or not it was the PWC kind of alumni association at VARA,
Yep.
the Variable Assets Regulatory Authority in Dubai, or the ADGM. Do you have any thoughts about kind of those in a world where we see a new digital Silk Road and digital embassies emerging? Does that part of the world in the GCC especially catch your attention at all?
I'm certainly watching it. I would tell you it's probably too early to tell how those
Yeah.
things are going to play out because there's just not enough stuff there yet, right? This is one of those, I could speak theoretically on that, but I try not to, right? I want to see the data. I want to see what's actually going to happen. Some of those look decently promising to me. Some of them I think have mechanical problems. The question then becomes, and this is why it's too early, do they learn that and rapidly fix it? Great, right? Or are they set in their ways and they just stick to it and refuse to iterate, in which case you're going to throw your hands up and walk away. So I would tell you, for everybody in the UAE, right, and that sort of the Middle East in general, I think it's a good effort. You need to try to get that right. It does genuinely help trade and becoming a financial center. The thing to do is be responsive to what's going on. And you need to, when you listen to that, listen to both, call it the people in the industry who are trying to get you to do things, but also the informed critics. Because obviously, one side will always talk their book. One side is probably too skeptical. The truth will always reside in the middle. By the way, similar advice for Singapore and Hong Kong, where again, it's probably a little early to have a strong opinion of what's going to happen there.
I'll be sure to bring that up when the Bretton Woods Committee goes to Singapore in a couple of weeks to host our 2026 Future of Finance Forum. I'll bring that up over there. Um, Austin, I have to ask you, regardless of where you sit, there's so many of our members are rightfully proud of the institutions that they helped to create, that they've helped to lead, that they helped to build, that have experienced an incredible, window of stability in the financial markets, the capital markets. And it's been hard for many people to wrap around all of the nonsense in crypto and take it seriously. But even with that said, when you look back on this notion of a choke point 2.0, which many people called a conspiracy theory for a long time, do you have any thoughts about that and what can be learned from that moving forward as we continue to march on? The future, because we're continuing to march on here, but maybe share a little bit with the members what that is, that choke point 2.0 business from your perspective, what it was like working in the industry and dealing with that directly, as I know you did, and kind of how do we reconcile that?
Yeah, so as a starting point for anybody who thinks it's a conspiracy theory, go look at the documents coming out of the congressional hearings on that, the U.S. House Oversight and Investigations Committee. Like there was a study by John DiAgostino and the AIMA on this that looked at the differential between hedge funds handling crypto and hedge funds not handling crypto in terms of banking access. Right. And I want to be clear, these are like registered funds. I'm not talking about three dudes in a broom closet in an undisclosed location. I'm talking about like registered asset managers with all the paperwork. We know where the people are.
Let's leave three arrows out of this, okay, please? Jeez.
Yeah, I'm literally excluding them, but we're talking about like, I don't know, subsidiaries of Brevin Howard here,
Yeah,
and they
yeah,
couldn't get bank accounts,
yeah.
right? Whereas the people doing hilariously risky things in traditional financial spaces and blowing themselves up, like the Archegoses of the world, could easily get bank accounts. And so it was very clear it was not a risk-based determination. It was just discrimination against the space as a whole. And this kind of relates to what you said earlier, which is to say, my critique of a lot of the banking regulators in the United States would have been you threw the baby out with the bathwater. And what I mean by that is, and by the way, this was also the story with Operation Choke Point 1. So the
Yeah.
fact that we had a 2 tells you it's a systemic problem, not a
Yeah.
crypto problem, because the
And
first
just to
one,
refresh for our global audience, during the Obama administration, rather than confront some of these emerging industries that were a little untoward in the eyes of the administration directly, there was an effort underway, whether it was with respect to cannabis licensing and banking, or whether or not it was, payday check cashing in advance, as an example. There was a concerted effort to not allow access to the traditional financial system. That was choke point one. So go ahead. I'm sorry.
Yeah, correct. And there are some interesting lessons that come out of both one and two that lead to the trust problem that we're having in the current world that are reflected over and over. But a good example in choke point two is if you told me, wow, FTX happened, that's very bad. We should probably go make sure in granular way that people who are operating like that or affiliated like that don't have banking access and aren't stealing customer money. I would give that two thumbs up. Like I'm a former chief risk officer myself. That's exactly the job. You 100% should be doing that. The
Yeah.
problem is it sort of spiraled out of control from there into actually, we just hate crypto. And you can find this in like comments from people at the FDIC that were disclosed, some of the things that was happening at the Federal Reserve, the OCC, and a lot of the effort started from a place of good intent, but just became an act of prejudice, right? Where it's like, well, actually, all the crypto people are bad. And I'm like,
So I think
again,
that's a, wait, wait. I think that's an important distinction. Many of our members resemble those entities, and I want to be very clear. It started off, I believe, with noble intent or a debate, right? We just don't buy in. We don't believe. What you're saying is it morphed into generally just a steamroll for uh,
I
ideological reasons or to preserve the legacy incumbents. Do you believe?
I think so. There are some good logical reasons for being careful about risk in this space with high volatility assets.
Yeah.
There are some, call it biased but well-intentioned reasons of we think there are problems here and probably haven't done our homework and gotten granular enough. So we're kind of shooting the innocent along with the guilty as we go down the firing line. And then there's some element of just we don't like change. We don't want to deal with this stuff. We don't want to do our homework. So get rid of all of it because it makes our job harder. And then finally, let's be honest, there was definitely some degree of political meddling. And if you look again at efforts across this space, things like interdicting the money laundering efforts of the pig butchering scammers is something we totally should have done. But it's hard to square this being a good thing with looking at like, here's a good example, like FDIC pause letters for entities that were dealing with NYDFS regulated entities with no money laundering problems purely because Bitcoin was involved, right? Where they were just like, no, we're banning that, even though it's a completely legal asset, right? Again, imagine, let's take this out of crypto. Imagine that US banking regulators said, we think gold is very high risk, and therefore anybody who owns gold, transacts in gold, or mines gold should not be involved in the US banking system. How would that be received?
Yeah.
And so the problem there is not to say everybody in transacting in gold is honest, they're not, but categorical bans are a problem. And when you look at like the extreme conduct there, maybe the best example of this was the SEC versus debt box, where it turned out that the SEC, and I'm telling this to people here verbatim, if you don't believe me, go pull the documents from the case. It was in Salt Lake City.
Yep.
Um, the SEC committed perjury in an ex parte hearing, lying that the company was hiding their assets by moving them abroad when actually they were in a credit union in Wisconsin. The SEC was aware of that. And the reason their bank accounts had been closed was not the entity closing them, it was regulatory pressure on the entities banking them. You cannot go to a federal judge and lie to them about these things. This led to the disbarment of multiple attorneys and the
Yeah.
closure of Salt Lake City office for the SEC. So there were not
Do,
clean hands all around here.
do you think that now that we are in a more, regardless again of the partisanship here in the United States, but we're clearly in a more pro digital assets, pro future of finance administration. Are we still seeing lingering effects though from some of this choke point business? Do you still see that in play as far as the industry is concerned?
Not as far as the crypto industry is concerned, but yes, 100% as far as institutional trust is concerned. And this is sort of the core problem. Like, if you read my testimony, I talked about this. We're just going to have choke point three, and then four, and then five, and then six, unless we clean up the core problem here, which is like if you're somebody in Europe who's skeptical of Trump or you're a Democrat in the United States, I want you to know that right now, the Trump administration has every single tool at their disposal they would need to run this exact same program against like NGOs, against academic institutions, against journalists, against abortion providers, right? Until we fix the problem of arbitrary judgment covered up by confidential, like supervisory
Yeah.
information, you're not going to be able to unwind this because any administration that wants to do unethical things can. And so the real effect here has been an erosion of trust in these institutions because people on both sides legitimately believe that, hey, if the people in charge don't like us, they can just break our access to the modern electronic payment system. And when that is the norm, if you want to look at why so many people are very interested in crypto and getting away from the traditional banking system, fundamentally it is an issue of trust. And yes, I agree. There are a lot of screaming lunatics in the crypto space. Like, trust me, I deal with them on Twitter pretty frequently. But the core observation about trust is real. And so, unless that is addressed, this whole thing is not going away.
What I love about you is you take arrows from both sides, kind of like me. I love it. You have no problem doing that. Let me go to a question, a really good question. It is a short question, but a very, very deep topic from one of our members, Greg Baxter. And his question is, how do we create a regulatory level playing field without space for regulatory arbitrage?
The number one thing you need to do is zoom out from the technology and look at the core economic activity, right? Like, here's a very good example of that, which is the Genius Act. Stablecoins are fundamentally bank deposits or the kinds of securities you would find in an SEC regulated government money market fund inside of a box. Therefore, the rules that govern these things should largely be similar, whether you're doing them on chain or not on chain. And the parts that are different need to relate to fundamentally different properties between those two systems. Again, black box, hard to observe transactions versus completely open field might lead me to different ideas on KYC AML, but it should 100% not change my views on what are adequate reserves for a cash stability product. It also shouldn't change my view on should I be able to pay interest on these things or not. So the core thing you've got to do is stop over fixating on the ledger technology and look at the core economic substance. Because to say it a different way, I think it would be patently insane to everybody in this group for me to be like, equity in companies. We should regulate that differently if we recorded in Microsoft Excel versus Microsoft Access, right? Like, that's pretty self-evidently nuts. But
Yeah.
that is kind of what happens here when you lose sight of what you're doing. So really stop, take a deep breath, look at the economic substance of what's going on, and zoom out from just focusing on the technology, and you'll get to the right answers.
As I said, a short question, but a very, very deep conversation. I think you distilled it down on a Reader's Digest basis pretty well right there. I'm going to go to a longer question, but maybe a shorter answer, if you wouldn't mind, given the interest of time, from David Cervantes, who did yeoman's work on the construction and the collaboration for a forthcoming tokenization paper from the Bretton Woods Committee that will launch in Singapore at the Future of Finance Forum. But David asks, as Congress considers market structure legislation, how important is legislation that addresses AML CFT in a much more robust way than currently presented? Could the legislation create an SRO to develop standards for network level compliance prims, credential schemas, revocation registrars, disclosure formats, so that compliance is interoperable across all those rails? So I know this is right up your alley a little bit. So would you mind taking that one? He has a follow-up, but we may not get to that one.
Yeah, I mean, in simple terms, it's pretty obvious the current system is broken. So one would hope they would be willing to address this, right? Like, the current framework in the US probably produces maximum paperwork and minimum interdiction, which is
Right.
double bad because we're helpfully creating honeypots when people get hacked of customer data to commit even more fraud. It's very backwards. I do agree with you that interoperable compliance should be the goal. I think it's harder than you'd think because when you get all the regulators in a room to get them to talk across jurisdictions, they mean different things and have different laws about what can happen, but we should get as close as possible. I think that's a very valuable goal. And two, I agree with you that you're going to need like base level standards for all of these things. I am doubtful that an SRO is going to be particularly helpful here because these parties do not have a good history of working together or even understanding the problem. I think what would be better is probably taking those standards by having somebody that interviews all of the banks, all of the crypto people, asset managers, payments companies, but also very importantly, law enforcement and intelligence people on what is going on here and tries to come up with best standards that work for all of them. I think self-regulatory, quite frankly, people don't take this seriously until after something bad has happened. Like
Yeah.
Greg, you referenced CZ and going to jail for money laundering earlier. There have been vastly worse problems in the traditional system.
I
Look
know.
at TD Bank, look at HSBC, look at Deutsche, look at ABN AMRO, look at Citi, right?
I know.
Everywhere globally, it is a problem. I don't think an SRO solves that because they've demonstrated they aren't going to do the work. But I do think there's a way to get a consortium together to do that for David. And I think that's a very good idea.
Real quick answer if you don't mind, but I'd like to get your thoughts about it. We made it this far in a conversation without having to get into predictive markets. So we'll spare everybody on that one, but I'm not going to spare you on talking about everybody's favorite, emerging technology, quantum technologies. And so, without getting into too much superposition and so on and so forth, given the clients and the breadth of clients I know you work with, are we spending enough time on that topic? Do you see it as being as potentially disruptive as some of the folks that are really, really concerned about it? Do you share that concern?
Well, to quote one of the great American philosophers, predictions are hard to make, especially about the future. So don't hold me to this one. But I think as you look at quantum computing, theoretically, if the optimists on the technology are correct, it is kind of self-evidently a very big threat to many currently used forms of encryption. That's not to say it's unsolvable. I think where I come down on it is it's less important to have concrete, specific solutions in play right now than it is to have a playbook to keep up with that space as it evolves. Because again, to go back to the lessons we've learned, if I solve for the threats of the 1995 internet, I have real problems in 2005, much less 2025.
Right.
So security is sort of an ongoing, like bad guy, good guy, bad guy, good guy, bad guy, good guy ladder climb. And that's also true of the technologies used for it. I mean, kind of the weird good news is like crime is sort of a leading indicator of the importance of technology because if they're putting that much effort into it, it matters. But I would tell people quantum resilience right now, to me, is more a matter of monitoring, understanding capabilities, and staying up to date on that with potential solutions than it is like an, oh my God, we have to implement it right now sort of problem.
A final question, and Rod, I apologize. I just saw yours now, but I have another one that's in the queue here. What advice would you give Kristalina Gordieva at the IMF or
Yep.
Ajay Banga at the World Bank as it applies to their integration or their adoption of these technologies? I mean, I have some strong views. We don't need to hear those now, but what are your thoughts in the course of the next minute or so?
One, the transparency angle is incredibly important for you.
Yeah.
As we go back to all of the problems around institutional trust and why people are pulling back from these sorts of organizations, if you instead are front footed on good governance and transparency, you're going to win a lot of hearts and minds, right? The reality is, a lot of the decay that we've seen in institutions is not a partisan position from any political like group in the US and Europe, et cetera. It's more a question of like legitimacy. Like, I don't trust these people. It seems like there's a lot of fraud. How do I know? If you could lead with trust and transparency, you are going to win. And these systems are some of the best in the world for it. Like, I will remind everybody that Hamas had to tell people to stop sending them Bitcoin because it was too easy to spot and interdict. Move towards the light and transparency. It solves so many of your problems.
Question: were you more nervous before your first congressional testimony or before you were doing 60 Minutes?
Uh, Definitely before the first congressional
I
testimony.
thought so.
And that's mainly because the nature of testifying in front of Congress is that you have to do a 5 minute opening statement on what you are attempting to talk about. Most people do this by reading it off a piece of paper, which, in my opinion, produces an incredibly wooden and sort of static performance. So, because I'm a college professor and mildly insane, I'm like, I think I can do this. If you look at my original testimony, I have a neon green notebook that just has bullet points in it in front of me. And that entire opening statement is just me ad-libbing between the bullet points because you want to read the room and the reactions of people. But also, there's a certain amount of you don't have a written statement to fall back on. So I'm like walking the tightrope without a net for that one, Greg.
Well, look, I think I speak for everyone that, as a part of our membership community. We appreciate you carving out your time to be with us today. The insights and the candor I knew you would deliver for our audience, and very, very grateful, Austin. So on behalf of the Bretton Woods Committee Board and Advisory Council, our Secretariat, thank you very, very much for joining us. And to all of our members, I do hope you heed the clarion call right now, which is there has never been a better time, a better moment for the Bretton Woods Committee to be more relevant than in the conversations that are taking place globally right now. So thanks for your engagement. Take care, everyone.